All right, good afternoon, everybody. Chris Lester here. I'm going to be your presenter today. I want to thank all of you for taking time out of your busy schedules to join us. But I'm back here to bring to you updates to the market, and for the most part, it's good news right now. Right, we've seen clear skies, and I want to take us through our continued trend of a rear view mirror look at what last month brought us, and sort of just take a sort of a macro view of what we see, what the data points tell us what has happened versus looking at the speedometer as we go. So without further ado, the first two slides are equity slides, and if you've not been on this call before, basically everything's color coded. So I'm going to go, just a high level review. This is a monthly snapshot. So even though it says June, we're in July, and it's a view of June's data points from the beginning of June to the end of June, which is why it takes us 2 or 3 weeks to put it together. And then, if you look at the top blue, right, that's the Russell 2000. So that's typically small businesses. So US small businesses did well in June. And then the purple is the S&P 500. And your 401k statements may reflect that if you're invested in some of those mutual funds or ETFs. The next one following is real estate, right? So, Vanguard Real Estate says, hey, real estate has done okay. And then the Dow, which finished up today, but everything for the month of June was positive, right? Now, when I fast forward to a little bit further out, we're going to take a step back. Not so for the entire indices. So commodities are still under pressure, which is the last one, or that golden color look. But finishing on the top was actually the S&P. So for the year, it's done pretty well. And, this is why we always caution to say, hey, you can't time the market. You can't listen to the talking heads. There's a lot of data points that drive the market. And a lot of times news is already built in. So, things like rising inflation rates, global conflict, right? There's a lot of things that can put pressure on a day to day. And you hear the news and you would think the sky is falling. But for the most part, we knew that, Q1, Q2, and as we start to look into Q3, Q4, you'll start to see that, hey, using nautical terms or aviation terms, navigation terms, we're going to say I feel, my personal opinion, there's some storm clouds on the horizon. And now where exactly, I don't know, but I do see some signs that are concerning. But right now, as I play Monday day quarterback, I'm comfortable with a diversified portfolio in equities, saying, hey, US equities, even developed countries, which is that teal green there, that neon green. The second one that's Europe, right? So you're saying, hey, even Europe is feeling, some positivity as we go forward. And then into small caps US, and in even, developing countries. I use hot pink. I view that as China, Indonesia, even areas of Brazil or third world countries. This is where, for the most part, have done okay for the year. Again, the only thing that's really been concerning is, commodities, and that's just because of their components, inflation, precious metals, and oil, the same old, same old. So if I've talked about those before, if you've got questions on it, we can further review. But that's sort of a hindsight. And then, the good news here is we had a green line appear, right, last month. And that is typically, this chart is sort of a technical indicator that basically says, hey, listen, you know what, there are things on the horizon that say that then things tend to gravitate, or trends tend to move into a direction. So as I look at this chart, and we had started to see the crossover point. So the top area here, if you can see my mouse, this indicator, there's three different graphs here on the same chart. And these three indicators tend to predict a direction of the market. Doesn't mean it's absolute, doesn't mean it can't flip on a dime. But the first one is RSI. It's a momentum indicator, relative strength indicator. The next one is your moving averages, right? And then your crossover. So that has happened. And now we finally got a green light there. And then the last one is MACD, which is a moving average convergence and divergence. So they're just technical indicators that say, hey, listen, when all three of these levers flip, these levers switch on, that we tend to feel that things will continue to move in an upward trend. How long? We don't know. But that is, an indicator that from an investment standpoint, and typically, especially if we're still working, buy and hold, equities show positivity on a go forward. Now, like I mentioned earlier, I do see some storm clouds. So what do we do to adjust? Not much. I would just continue to, right now, if your portfolios are in equities, depending on actually your specific circumstances, your retirement dates, things of that nature, that we don't panic, right? That we don't empty the apple cart. We don't take our chips off the table in order to get returns and in positive outputs coming in, right? That we need to be in the market. So that was not always the case, right? Especially last year coming in, as you can see, when we had 2022 and we had some of this downward pressure, it did come, and it took a while, right? Almost a full year for it to start to turn green again. So you will see that cycles, and we just want you to be in the market and understand that as you look at the news day to day. So remember, this is always a month ago. So this was the if we were able to measure or take a heartbeat of the economy right then this would have been sort of our EKG of the economy then. So now on to income markets. So the bond portfolios, and again, a monthly snapshot. For the most part, everything did well, except the 7 to 10-year treasuries lost a little bit. But if we fast forward and we take a macro approach here, for the year, if you're on a fixed income portfolio, if you're deriving revenue from some type of bond holding, right, that for the most part, everything's been positive, which is good news compared to last year. Now, 20-year treasuries, typically people tend to fly to here if they're concerned about the economy. And that's one of the areas where I have concern. It's a consumer sentiment. What do people think's happening? Are they nervous, right? Are they concerned about inflation? Do they think that there's governmental risk? Do they think that a recession's on the horizon? So right now, when people tend to flight to safety, that's sort of one of the areas where you say, should we take notice? So it doesn't mean panic. It just means that when we've seen that before, and you can see it's been all over the map for the year, right? So right now, there still seems to be a little bit, it's leading the trends. And, it just goes to show that if you want money in a safe place, bonds, where I was very cautious over the last 10 years, if you're on a fixed income, can pay coupons, predictable rates of return. So it's something that should be part of your portfolio. And as I mentioned in the past, typically where we see rising interest rates and the Fed is still giving indications that they may raise interest rates in the future. Now, probably a third of what we see in the marketplace has that information already baked in. So you'll see day-to-day volatility and swings, but for the most part, we're seeing, continued positive numbers on return on investment. This is good news. And so, what do we do on a go forward? Again, I have concerns about probably not so much Q3. I think we'll start to see some upheaval or some layers get peeled back, but I don't know that it will actually happen in September, October. But I do think by Q4, as we start to wrap up the year, you will start to see some of the shaking of the trees, and you will start to see some corrections in place especially if some type of global event pops off, or some of the the political news that we see in the headlines starts to heat up. You'll see some of that happen, and then if the Fed comes out and starts to increase or continue to increase borrowing rates in an effort to curb inflation, we could see that have an impact as well. But right now, the report is the first half of the year been pretty good. Now, again, we have a green line here, and so the same indicator, but for the income portfolios, is still showing, hey, keep your money on the table. And so, my advice in the past has been, if where I was concerned about rising interest rates, I was like, hey, don't freak out, right? But we can start to allocate our portfolios at work to maybe have a little bit less risk. But now that, we're seeing some longer term, more stable, more rates of return that we're accustomed to, we want to make sure that we're taking advantage of that. And sitting in cash is probably not an ideal situation. So I like being in the market. I do think balance is important. Depending on how soon you might need money, would determine whether you want a 50-50 holding, a 60-40 holding. If you got a few years until retirement, maybe even 70% equities. But the key here is, and I think one of the successful recipes for retirement is dollar cost averaging into the market. So when you put money into the market and you set it and forget it, like just out of sight, out of mind, putting money away for your future self is very, very important. So, both stocks, equities, and bonds, income, that, we've had a good year so far. Now the question is, how do we keep what we've earned, right? And so right now you can't make knee-jerk reactions. You need to have strategies. You need to have some semblance of an idea or a roadmap when you're going to need the money. And then we can make suggestions on how to reduce that risk should things unforeseen happen. So again, basically good news this month. I wanted to just share that with you. And then lastly, the recession probability analytic tool. This tool here was created by Formula Folios, and then when Brookstone bought it over, they have continued to build upon this. Now, the thing that jumped out at me here is we had actually started in April, started to come down, and we were about 74. And then last month, we were at 87. So remember, 50 is the baseline. If we're above 50, this is saying that there is a recession probable in the future. Now, when we can't, I pinpoint it much to what I just said, but what I did see is that from May to June, we actually went up. So there are, out of 100 data points that they look at, analyze, and build algorithms around, that they have looked at and said, you know what, we have concerns. And that's why we have to be strategic in our investments. And that's where, remember, we talk about systemic risk versus unsystemic risk, that there are some things that we can diversify away from. Unsystemic risk, we can usually combat with diversification. But systemic risk, we can't, right? So if things like an earthquake hit, right, that's going to affect everything in the room. Right. And so that means regardless of how diversified you are, we're probably going to feel some pain. Now, there are mechanisms or things that you can, places you can invest your money to really reduce some of that risk. Right. We'll call it earthquake protection, but that's not the purpose of today's call. But if you want to find out what you can do to start to de-risk your portfolio, start to have more of an awareness of what's coming down the pike, then you need to reach out to us. But other than that, I think, it's good news on the horizon. Until next month, we have a call next week. I am in Nashville for the beginning half of the week, and then I'm back. But, this is our